Ladies and gentlemen, welcome back to the channel and welcome back to another day where AMC is outperforming the markets almost on a 2-to-1 basis. AMC stock down about 1% currently, whereas the Nasdaq and the S&P are down almost 2%. Now, the most important thing I want to point out here in this video is what is actually going on with the Fed futures, what the markets are expecting the Fed to raise rates at the next Fed meeting. Spoiler here, it's 1%. We're gonna get a 1% rate hike. Let that just sink in for a second. But also, JP Morgan is suspending its share repurchase program or share buyback program, and also is not able to boost their dividend. This is because they hold a lot of risky loans, and this is something we are going to elaborate on here in this video. We're going to go over everything you guys need to know about AMC stock. I am incredibly bullish, especially after today. This is really a narrative shift. This is really a broad-based sell-off where nothing is really immune, and AMC stock is performing very, very well. So is GME. So we got a lot to talk about in a very short amount of time. Hit that like button and subscribe to the channel if you guys have not already. Thank you guys for doing that. This is one of the more important videos to help push out. And hitting the like button and subscribing to the channel, and also commenting down below, what is your take on all this? When do you think the markets are going to bounce? Are you buying puts? Are you buying calls? Let me know what you guys are doing. All of that helps to push this video out to as many people as possible. So thank you for doing that. If you guys want to come trade with me live in real time, link down below in the description of this video. We did just hit a trade that was purchased a couple days ago, a SPY 380 put for actually this Friday. $192 was spent on that, just cashed out for over $900. That profit would pay for the trading community cost for multiple years. So definitely check it out if you guys are not a part of it. But let's get straight into this information, guys. So AMC stock down about 1.19%. Look at the S&P 500 down about 1.73%. The Nasdaq down about 2%. So what is really causing this move down? Well, I will say the first thing is that the markets are now pricing in the probability of a 1% rate hike at 85.1% after the CPI report that we did get yesterday. We actually started to price this in. By the close, we were sitting at about an 80% chance, kind of where we are right now, of this 1% rate hike, but the markets were not fully pricing this in as of yet. And we're going to talk about what is really going on as far as fears of a recession, inflation, why the yield curve is inverted. But the long story short for right now, we're going to talk about that in more depth at 4 p.m. But the long story short is the markets think rates are going up in the short term, but the Fed will be much quicker to cut rates over the long term. That is why investors are selling the 2-year bonds, meaning the bond yields are going up. Think about this like a dividend stock. If a dividend stock pays you 5% and that stock drops 50%, well, now that dividend stock is going to pay you 10%. That is how bond yields work. So when investors sell bonds, it makes the bond yields go up. That is why a 2-year pays you more than a 10-year bond by 0.25%, by 0.25%, because investors are going out and they are buying the 10-year bonds. Because, hey, if you could buy a 10-year bond for 3% and the Fed has to cut rates, and in 10 years' time or 5 years' time, whatever longer duration time frame you're talking about, if the bonds are only paying you 1%, 1.5%, 2%, 2.5%. Well, that's a really good deal to get a 3% yielding bond. And this is because people are fearful the Fed is going to make a mistake and force us into a recession pretty quickly. So there you have that. That's a little golden nugget. Make sure to let me know what you think about that down below in the comment section as well. But we did get data. We got PPI, Producer Price Index, and essentially this went up 11.3% in June, near the record high that we seen in March, which was set at 11.6%. Excluding food and energy and trade, core PPI was up 6.4%. The monthly gain of 0.3% was below expectations. So that is a good thing. That is obviously a good thing. Now, jobless claims jumped to 244,000 last week, the highest level since November of 2021. So that is also showing some weakening, some slowdown in the labor market, and that is definitely a good thing. Now, you just have some breaking news coming out. Fed Governor Waller says he's open to larger rate hike this month than in June. So, larger rate hike than in June, 75 basis points in June. What is that? A 1% rate hike. So we'll see what happens coming at this July meeting and ultimately when the Fed will raise rates on July 27th. But he says, quote, "My base case for July depends on incoming data," he said in remarks at an event in Victor, Idaho. Quote, "We have an important data release on retail sales and housing coming in before the July meeting. If that data comes in materially stronger than expected, it would make me lean towards a larger hike at the July meeting to the extent it shows demand is not slowing down fast enough to get inflation down." That is what is going to lead me into the next point, which is retail sales that comes out tomorrow. And like I've been saying over the past couple of days, if this comes in good, if this comes in better than 0.5%, which is the estimate, well, we're going to get a 1% rate hike. And then it's going to feel a little bit more real to the markets, and the markets are going to have to start paying attention. And this is the worst case scenario, because if markets are fearful about inflation, which we have been over the last couple of months, but then you get fears about a recession, well, the markets are not really falling all too much as of recently, as the markets have been fearing a recession, because obviously recession comes with massive deflation. It comes with lower interest rates. But the worst case scenario would be this looming recession somewhere down the line, company earnings going bad, right? We'll get like 30% of the S&P that reports the week of the Fed raising rates. That Friday will be July 29th. But worst case scenario is we have high inflation for a long time and we get good economic data, giving the Fed the room it needs to raise rates. And then ultimately that looming recession down the line, meaning the Fed potentially could push us into a very deep recession the more and more they are able to hike until we do go into that ultimate recession. So that's the worst case scenario. Retail sales coming out tomorrow. That is going to be very important, like Fed Waller just said, and he is a voting member for this upcoming meeting. Now, Morgan Stanley misses analyst estimates on worse than expected investment banking revenue. Now, Morgan Stanley's earnings, not all too good. Earnings per share $1.39 versus $1.53 expected. Revenue $13.13 billion versus $13.48 billion expected. Not all too terrible, but and it is a 55% decline in investment banking revenue, obviously due to the lack of IPOs, the lack of new public offerings, all of that. But JP Morgan earnings are a lot more scary, we'll just call it that. JP Morgan Chase earnings fell 28% after building reserves for bad loans. Bank suspends buybacks, and I think that really sums it up. But what JP Morgan actually did was put $428 million additional dollars in their reserves for bad loans. Now, it says Chairman and CEO Jamie Dimon warned geopolitical tension, high inflation, and waning consumer confidence could hurt the economy sometime down the road. And I think this share buyback program is very interesting, because if there was ever a time over the last 2 years to buy back your stock, it's definitely right now, and they just canceled doing that. So that shows that they are really not in a good situation financially as of right now, and they probably have a lot of bad loans, likely to hedge funds that are in trouble, that are not doing so good, that are on the verge of bankruptcy. AKA, in my personal opinion, we get another 10% move down from the lows of 2022. Well, you're probably going to see massive losses for these banks. Something else that just happened. It says, we'll just read this whole paragraph, kind of what I just said, but than talking about the dividend. With this outlook, JP Morgan has opted to temporarily suspend its share repurchases to help it reach regulatory capital requirements, a prospect feared by analysts earlier this year. Last month, the bank was forced to keep its dividend unchanged while rivals boosted their payouts. This is because the Fed is paying attention to the balance sheets of different banks. And when your balance sheet is filled with a lot of risky loans, a lot of risky assets, well, the Fed will not let you boost your dividend payout because they want to make sure banks will be okay if people start to default on these loans left and right. And this is really showing you something, that JP Morgan has their hand in a lot of bad loans. I personally think they're lending out to a lot of hedge funds and charging them massive premiums and not really taking into consideration that risk management aspect. I think they did a lot of bad lending over the past 2 years, and now they're trying to play catch up to essentially get the reserves up to what they need to be. If you start to see, some more massive downside in the markets, and given where the margin debt is currently at about $752 billion, only down about 15% for 2022, given the NASDAQ almost down 30%, you're really seeing portfolio values decreasing and margins staying pretty much the same, meaning that range that you can see before you start to see massive margin calls is really getting compressed. And this is not going to be a sharp drop, sharp rally back up like the COVID crash. This is going to be a sharp drop, likely remain down there for a little while and then start to make our way back up. So it's not like banks will just be able to get their money back out of these loans quickly. It's not going to happen. So if you start to see more hedge funds going under, which I do think they will, JP Morgan is probably the one that's going to take a lot of that hit. And potentially they could even start giving out forced share recalls. They could start calling on their loans to be returned because ultimately they can do that anytime they want. So I do think all of that is on the table here in the near term future. Now, as of right now, S&P down about 1.5%, AMC stock up almost 1%, breaking out back again above $15 per share, looking to make a new high of the day. So very encouraging. I mean, how could you not be encouraged by what we are seeing for AMC? This is now the 1, 2, 3, 4, almost the 6th positive day in a row. Yesterday did break that trend, down about 2.95%, but 5 out of the last 6 days have been green days. You are breaking out above $15. You're holding up at $15. It looks like support. We're going to break out above that 100-day moving average, and we are going to test some massive new levels. In my personal opinion, $20, $30, $40, $50 per share, definitely not off of the table. Now, let's take a look at the Ortex data, and then we'll take a look at the Stocko Tracker data, because I think that's very important, even considering tomorrow, where you could potentially see a little bit of a gamma squeeze, a gamma bounce, whatever you want to call it. So as far as option activity for the day on AMC, 7 orders totaling $1.1 billion, positive order value of 9%. So not looking all too bullish at all. Now, short interest, 18.24%, down from where it has been over the last couple of weeks, but up from the last week. And you do have a free flow out on loan of 26.11%. Shares out on loan 134.61 million. Days to cover at 3.29. Cost to borrow 11.91%. 100% share utilization. Cost to borrow max at 15.91%. Cost to borrow average of 10.07%. Cost to borrow minimum of negative 0.2%. Take that with just a big grain of salt, guys. You're not going to be able to lend out stock or borrow stock of AMC for negative. You're not getting paid out to borrow AMC stock. The cost borrow right here still says it's sitting at about 10%. So my personal opinion, this data does look very, very encouraging. And also the Stocko Tracker data, if we go ahead and refresh this, you have about 68,500 calls that are currently in the money, 521,000 calls that are out of the money. You do have in the money puts at 69,000, out of the money puts at almost 160,000. So what we're looking at right here is if AMC can make a move to the upside tomorrow in a big way, or by the end of the day today, and really start to break out above 16, above 17, and even get close to 20, you could see a very substantial move up in the share price of AMC. Let me remind you of how familiar this looks to the last March rally that we've seen, right? You come up, you break out above the resistance level that we had previously seen at $15 per share, come up to the moving average, find resistance here for 3 days in a row. What do you see back here? Well, you came up resistance level, found resistance 3 days in a row. On that fourth day, which was actually Tuesday, you did break out with a 45% positive day. So if that were to work the same way, which it looks very similar to what we are seeing, doesn't mean it has to, but it looks very similar, then you could be in store for a very big move coming tomorrow. So that is pretty much going to be all for this video. That is what you guys need to know. If we look at the actual option activity concerning a gamma squeeze for tomorrow, 7,500 calls that are currently in open interest at the $15.50 strike, about 19,000 for open interest at the $16 strike, 7,000 at the $16.50, 10,500 at the 17, 3,300 at the $17.50, 9,200 at the 18, 1,300 at the $18.50, $19 strike about 5,300, 1,200 at the $19.50, and look at that, the $20 strike, 53,000 contracts. I almost said 5,300. You don't see 53,000 contracts all too often at the $20 strike. Same thing on the put side. As you guys do know, if the price of the stock does continue to go up, then when those puts go out of the money, that is also buying power that the market makers have to essentially buy shares on the open market. 5,000 at the $15.50 strike, 3,700 at the 16, and then you do have about 31,000 for open interest at the $20 strike as well. Take a look at the MACD. It's bullish, but it could get a lot more bullish. Take a look at the divergence and this gap you've seen back here in March and compare it to what we're seeing now. We are not quite there. The RSI is sitting at 60.31. So, you know, it's looking bullish, but it's definitely not to bad levels. So that is going to be all for this video. Thank you guys for watching. Hit that like button and subscribe to the channel if you guys found value out of the video. If you guys want to come trade with me live in real time, link down below in the description. Like I said, you guys enjoy the rest of your day, and I will see you in the next one.